Good afternoon. I'm Doug Loud, speaking for O&M Partners, and I want to welcome everyone to the Nomad Royalty Company Town Hall webinar. Now, just so you know, Nomad Royalty trades under the symbol NSR on the TSX and NSRXF on the OTC. For those of you who are new to these broadcasts, O&M is the link between the investing public and public companies. 6 years ago, in 2014, O&M recognized the sea change that was taking place in non-deal investment marketing. Suddenly, information was available to a whole new generation of investors who couldn't and or wouldn't be found in the key financial centers. Investors are receiving information at home that used to be geared and available only to professional investors. So O&M developed a digital roadmap to enable them to keep pace with the tremendous changes in investor demographics and how those demographics receive information. After the presentation, there will be a Q&A session. The questions in the Q&A session are for everyone. This broadcast will answer questions you might not have even known to ask. I know that always happens to me. Questions will be easily asked by going to the question portal of the GoToWebinar or by emailing us. For any questions that remain unanswered, we will follow up in a timely manner after the call. For those who've dialed in with their phones, unfortunately, due to modern technology, the only way you can hear our pre-recorded introductory presentation is on your computer speakers. If that's not possible, you will be able to hear the main presentation after 7 to 10 minutes, so please stay tuned. Our introductory speaker today is David H. Smith. David is a senior analyst for the Morgan Report and a ghostwriter. David has visited and written about properties in Argentina, Chile, Mexico, Bolivia, China, Canada, and the US. He is an investment conference workshop presenter at gatherings in Canada and the US. He is co-author, along with David Morgan, of Second Chance, How to Make and Keep Big Money from the Coming Gold and Silver Shockwave. Along with Mr. Morgan, he is advisor to the Lode Cryptographic Silver Project. His work for subscribers can be found on the Morgan Report and for the general public at Silver Guru. Now here's David.
It's great to be back at O&M Partners again to speak with you today. Today we're going to be talking about the royalty streamer model and why your portfolio needs at least one of them. Little disclaimer here that we always present at the beginning. Explorers help restock the resource and reserve pipelines of the majors. Producers deliver the goods to the market, and a royalty company provides funding to build a mill, expand a mine, harvest the ore, or discover new greenfield deposits. Bill Sheriff, executive chairman of Golden Predator, made this comment on one of an earlier O&M presentations, and I think he's right on the money. And he asked the question, why are royalties outperforming almost every other type of mining concept right now? It's because they generate revenue for themselves as opposed to spending other people's money by drilling and financing again and drilling some more and eventually having a very bloated share structure. And he's right that this model really is, if it's not broken, it's very close to. And companies that do this as opposed to generating revenue while they're looking for something really are not going to be doing much service to shareholders going forward, even as this bull market moves forward rapidly, which it's doing as we speak. The definition of a royalty and a streamer are a bit different, but today we're going to use the terms interchangeably. The difference has to do with how they acquire the financing and how they receive on their part of the bargain, which is slightly different, but they are complementary to each other. And indeed, royalty companies can use streamer model and vice versa. The central difference is that both of them hold a number of different types of resource sector items. The most common and popular are gold and silver and copper. But you also have royalties that deal in base metals and even coal or uranium. And probably the first company that come up with the royalty concept was Franco-Nevada, and they have been massively successful. And what's interesting about this concept, and I'd like to have people consider this throughout the talk, is that the royalty concept is extremely versatile and it is having constant new iterations being put in all the time by the participants. A real structured royalty company has a mix of current or near-term production and occasionally some exploration properties that might be brownfield, which would be on a known property area where production is already taking place, or greenfield, where we're looking for something that we don't know it's even there yet. So quite a mix that you can have in a well-structured royalty company. The basic difference then I want to mention about a royalty structure is that they finance a program with upfront payments, and they get a percent of the sales of the revenue versus the actual gold from the hoped for production. And this can be for a certain number of years, or it can be life of mine, which in the trade we call LOM. So keep in mind that the royalty is the right to a percentage of the proceeds from the miner's sale of the metal going forward. The streamer model is a little bit different. They can also help finance a mine or mill construction, and in return, they receive a stream, which is a specific number of physical gold or silver ounces per year at an agreed upon price. The most well-known of the streamers, and one of the earliest ones really, was Silver Wheaton, which is now called Wheaton Precious Metals, and they stream a number of different companies using this concept, where they buy the future gold production at a steep discount to the current spot price in order to pay money for the mining operation. And then when they get that metal, they sell it in the open market at whatever rate the prevailing rate is. And when the market is rising, like we're seeing currently now, where silver and gold are attempting to break out into new nominal highs for this move, they can make extra money beyond what they anticipated. And so a rising market can really fatten the coffers of a royalty company when they have a streaming model like this. We want to look at the advantages that having a royalty in your portfolio provides to the investor. There are a number of them. If you just hold a mining company, there are all sorts of things that can go wrong. A mine shaft can collapse. You can have run out of ore. There was a silver company recently that is going to sell a project because they have no more ore in that one. You can have country risk. Any number of things can happen. The grades can drop. But if you have a royalty company, they have a series of companies that have a contract to pay them a certain amount or give them a certain amount of metal. And it doesn't matter to them what happens to the mining company. They still get by contract what they've been promised. And so the investor is shielded, and so is the royalty company, from many of the risks that would accrue from simply having a mining company or an exploration company. They have diversification. There's not just one or two mining companies in a royalty. They can be 10 or 15 or more. And so that spreads out the risk. You have risk mitigation in terms of social or political or operational surprises. Mining royalties have much lower overhead, and they have a surprisingly small workforce with a high dollar performance per employee. And they can plow that money back because they're making income into buying additional royalties for the portfolio, or they can even sell a royalty. Sometime down the line, you might even find that the royalty company starts paying dividends. But the key thing is that they're bringing in money now, not at some imagined time in the future of 1, 2, 3, 4 years ahead. Royalty streaming operational cautionaries. There's always some risk involved. You have to be careful and balance out political risk versus the blue sky anticipation. You can have post-contract signing issues where there's a geologic operational risk. If you have a market downturn, which we went through several years ago and kind of coming out of that now, you can have a cash flow problem with the miner. It's really important that the miner under contract and the streamer itself does due diligence. They need to make sure they're getting what they think they're going to get and that it actually works out as they plan. The Morgan Report likes certain iterations of the royalty model. For one thing, it avoids what I call the ETF listing curse, where you have companies that are in an ETF, and if the company does really well, it becomes too large for the ETF in terms of a percentage overall basis. And so they'll sell a bunch of their shares in order to bring it back into alignment, which you can imagine hurts the shareholder who has that company, which suddenly now doesn't have much high price as it did before. Whereas a royalty doesn't have that kind of an issue because they basically have their own ETF, so to speak. You have backyard country risk mitigation. If you have a royalty company that primarily invests in what I would call politically safe, low country risk areas, especially US, Canada, Australia, and Europe are the most pronounced ones. They don't all have to be there, but your core positions ideally should be there to kind of keep things stable for you and the shareholder. Also, in these areas, the geology tends to be better understood and the rule of law is paramount. And those are very, very important in terms of you getting not only a return on your money, but a return of your money. So ideally, the perfect streamer royalty model is scalable and sustainable. It can start at very, very tiny, and it can go up, and it should be able to scale up to from pennies share type thing with well under $1 to many, many dollars if the model is set up properly, sometimes beyond what you could imagine. And I would suggest that investors look at the agreement structure that a royalty company has on their website before you invest and make sure that you know what you're getting. And they'll give you a good idea, in addition to talking to IR, as to what they're all about and their plans that they have in mind. The timing is just right for the royalty company and for people who invest in them, because as this chart shows, the relationship between gold and the shares themselves, the mining shares, is really out of whack and has been for many years. But there are indications that mining shares are going to begin outperforming the metal, as they should, of gold and silver going forward. And this will really go to the bottom line for the royalty companies and for the shareholders of those companies as we get that kind of outperformance, which by definition they should be doing because of a little bit of extra risk over the metal itself. And I think this is going to become the theme of the next few years, which is just one more big tailwind for the royalty concept and the shareholders who participate in them. David Morgan has a monthly letter. I've been an analyst at the Morgan Report for about 15 years. I really believe in this company that he has, and we have more mining companies that have gone on from explorer status to mining, actually becoming a mining company than anybody else in the business. And we will really treat you well. I really enjoy our shareholder base, and I think you will too if you would like to take a look at his value proposition. And I'd like to thank O&M Partners for giving me this opportunity to speak today. And I wish everyone here the very, very best as we go forward on this very, very exciting bull run that should run for at least the next 3 to 5, perhaps 10 years.
We're going to hear from Joseph Delaplante, the Chief Investment Officer and founder of Nomad. He's an accomplished executive with public company experience in all aspects of mine development cycles. Prior to his current role at Nomad, Joseph played a key role in the creation of Osisko Gold Royalties, where he led the execution of over $1 billion in financing of equity, royalty, and stream transactions, and two major transactions in his role as Vice President of Corporate Development. Prior to this, he was with Osisko Mining Corporation through the development, operation, and subsequent $4.3 billion sale of the Canadian Malartic mine in 2014 to Yamana Gold and Agnico Eagle. Prior to this executive roles, he advised resource clients in both mergers and acquisitions and financing at BMO Capital Markets. We should also note that Joseph is also founder and managing partner of Northern Peak Capital. Here's Joseph.
About that. Thanks very much, Scott and Doug. It's always a pleasure to be presenting as part of the O&M Town Hall discussions. This is not my first time presenting here. It is my first time presenting Nomad as part of this forum. So perhaps before launching into the presentation, I'll just give you a quick introduction on Nomad. So Nomad is the newest significant precious metal royalty company that has listed this year. We have a globally diverse portfolio of royalties and streams. We currently have 12 assets in the portfolio, and just about half of those assets are currently cash flowing. So a very unique platform to enter into the royalty space this year. We've only been trading for 6 months. So we're still a very new company. We are listed on the TSX under the symbol NSR. We also have listing on the OTCQX and SRXF. So for the US shareholders on the call wondering if they can participate in the trading of our shares, the answer is yes. And as a background for Nomad, we really started this as a partnership between three partners: myself, Vincent Metcalf, who's our CEO, Elif Levesque, our CFO. And the three of us were previously part of another royalty company. So we've been in the royalty space for over 6 years now, creating another business before Nomad. So we are not new to this. We are coming in with a significant amount of experience and very excited to take this business forward with the backing of our two largest shareholders, Orion Mine Finance, one of the largest private equity funds involved in mining today, as well as Yamana Gold. The timing for this webinar is great, actually. We just closed our third acquisition. We acquired Coral Gold earlier this year. Coral brings us a major royalty on a part of the Cortez camp. For those of you that don't know Cortez, it's owned by Barrick. It's one of the greatest mining operations in the world. So I will tell you more about this royalty through the presentation, but also because of the recent pullback that we're seeing in gold. Our timing for launching Nomad obviously was interesting given the pandemic, but really we were excited to see that we're coming into a very strong gold environment. Over the past week or so, we have seen a pullback in the gold price, and it has resulted in some overall weakness in the equity market for gold producers and royalty companies. But that said, this is a great opportunity for you to consider Nomad as a potential investment for your portfolio, given we are currently trading at the same valuation from a multiple point of view that we were trading when we listed the business. So great opportunity to have a second chance to come in at the ground floor in our company. So with that said, I'll go into the presentation. The opportunity here really is to invest in a team that's done it before. I'll talk a bit about the royalty business in the next few slides. But really, what a royalty company is, it's an investment company. We're a business that has a small team, very experienced, and looking to deploy capital into many different types of operations, many different types of jurisdictions. As I mentioned before, my partners and I spent the last 6 years building up our royalty business before Nomad. And so we bring a huge amount of expertise to this new business. And, as David mentioned in the introductory video, what's really interesting about the royalty space is you can generate huge amounts of revenues with a very small team. So keeping that G&A low with the team that we have is something that we're very focused on. It's also an opportunity to invest in a great business model. The royalty business has shown time and time again that it can deliver superior returns to the rest of the gold space and to other gold investments. And for the most part, if you look over the last 10 royalty companies that have been created, buying them in the first year has generated significant returns for their shareholders. So that's an important point to consider today as you consider Nomad. We're also a team that's focused on cash flow. It was mentioned in the introduction as well. Cash flow is the key to the royalty business. We're happy to say that we have one of the more significant cash flowing portfolios among the junior royalty companies, which we think positions us well to continue to grow, but most importantly, positions us as the best investment within the junior royalty space. We also currently pay a dividend that yields 1.8%. It's significant for a couple of reasons. Number one, because we're a new company. We've only been in existence for 6 months, but we've already paid our first dividend, and we're well on our way to laying a significant track record of paying consistent dividends. And at 1.8% yield, we are significantly higher than the rest of the precious metal royalty space. I'll tell you more about our portfolio in the presentation. It's a great portfolio. We have lots of cash flow, but also lots of optionality and potential exploration upside. And importantly, a significant amount of firepower to continue to grow our business. Between our credit facility, which is for $75 million, and $20 million of cash on our balance sheet, we have a substantial amount of firepower to continue to add assets to our business. Before delving too deep into the subject matter, it's worth talking about the royalty model because I recognize some of you on the call may be new to this type of investment. And so what I'll say is often when you're looking at royalty companies, what you're contrasting is investing either in the royalty companies or in the operators. And those are very two different types of investments, and I'll go through the reasons why. If you invest into an operator, what you're investing in are the earnings of one specific mine or a portfolio of different mines. So you're getting exposure to the commodity price, but it also comes with some risk because these operations have different types of cost structures and capital programs that are associated with them. And we know from history and from experience that mines are very challenging businesses to run. And they're, as much as you get volatility in the primary commodities that they're mining, you also get volatility in their cost structures. And so while the gold price may go up, your costs may go up at the same time. And instead of having margin expansion, you're really having stagnant margins, as well as the major costs associated with expansion and building new mines. And so contrast to that, an investment in a royalty business, you're investing in a company that has usually, or at least in our case, a number of employees that you can count on one hand. You're investing in a business that has margins of for the most part, 80% plus, and is generating significant amount of free cash flow in a way that offers diversification of assets and diversification of revenues, but also gives you all of the upside to the exploration potential of the underlying operations in the portfolio. You're also not on the hook for any of the ongoing costs or any of the ongoing CapEx programs at the mine. And so really the way that we think about it is you're getting all of the good parts and not so much any of the bad parts associated with these types of investments in gold. And this specific model has been in existence in its modern format for about 15 years. And over that period of time, it's consistently delivered superior returns to other types of equity investments and even to the underlying commodities themselves. So it's a great business model. Nomad, we add a little oomph to that. We pay a dividend that on top of all of the things I mentioned gives you that 1.8% yield. And significant diversification through the portfolio. If you look at the royalty business over the last 15 years, it's changed dramatically. And the context is important to understand if you're going to look at a royalty investment today. In 2004, the entire royalty sector added together was worth about $2 billion. Today, it's over 60 billion. And over that period of time, we've seen certain companies go from small companies into major companies, specifically 3 companies in our sector that are very, very large. And as well, you've seen new companies come into the market. And the main question that we get in this space is, it seems crowded. How do you guys continue to deliver? How do you guys compete for assets? How do you source new assets? Well, I think the important thing to understand is part of the reason for this growth in this space is because this business model has become more prevalent and more accepted within the overall mining ecosystem. And so, whereas 15 years ago, it was very rare that an operator would sell royalties on their operations. Today, it's very commonplace. There's almost no financing process of a mining project that takes place without calls being made to the royalty and streaming companies. And the reason for that is because as a group, the royalty companies have been very stable in terms of being present to offer capital to the different mining operators, in contrast to equity markets that have come and gone many times over the last 15 years. The way we approach this space is really building on our experience, and that's a key thing. Everything that we do at Nomad is based on lessons learned, both the good and the bad, from our time in the royalty space. We are a team that has been working together for a long time. Even before Nomad, Vincent Metcalf and myself started our careers together about 15 years ago. Elif Levesque and I have been working together for over 10 years at Cisco. So we're a team that we know each other well. We've done pretty much everything that you can think of in the royalty sector, from buying portfolios, buying existing assets, structuring new investments, being part of project financing situations. And that's very important when you consider a royalty investment, because really the team is where the value is created. Investing in a royalty company is as much investing into the portfolio as it is investing in the potential growth that's going to come in, because growth is where a management team can generate that increase in per share metrics, cash flow per share, net asset value per share. So the team is very important, and that is one of the big factors that makes Nomad stand out. You're also investing in a company that has a very diversified portfolio. As much from a jurisdiction point of view to a number of assets, diversification is very key to us. In fact, we really view our role as the management team here to deliver as much diversification as possible within the portfolio. And that's a contrast towards operating companies where as an operator, you own a certain set of mines and you only have a specific amount of team hours that you can dedicate towards your different operations that you are yourself running. And therefore, there's an emphasis on trying to get cornerstone assets that can generate significant amount of ounces to the operator. A royalty company is very different. We don't operate these mines. And for that reason, we're staying away from the cornerstone assets. We view our role to really diversify the portfolio, avoid concentration of risk, either from a geopolitical point of view, from a counterparty point of view, and really deliver that low volatility cash flow base to our shareholders. And the interesting thing about a royalty company is that your operating cash flow is your free cash flow. We are able to build a huge amount of revenue with a very small team. And because of our contract structure, we have no ongoing financial obligations, or not significant financial obligations towards the operators that we invest in. And what that means is that once we receive our payments and our ounces and we've generated our cash flow, that cash flow is available to reinvest or to return to shareholders. And really, our biggest cost as a business is our G&A. It's our management team, which is why we're very focused on keeping an extremely low G&A at our company. So for this year, we're forecasting just $2.5 million of G&A. That'll go up next year. And the reason for that is, for the first year of operation, the management team here at Nomad is taking no cash salary. We're taking our salary in shares. And so next year we're forecasting about $4.5 million, but that is well below what you see in the precious metal royalty space. And the reason for that is the management team at Nomad, we're significant shareholders. We view our shareholding in Nomad as our key compensation. And so if our shares do well, the share price does well, our shares will do well. And we are very aligned with investors to minimizing costs, maximizing cash flow, and returning parts of that cash flow to our shareholders through a dividend, and then reinvesting to grow the business. From a portfolio point of view, this is a very remarkable portfolio for our size of company and for how new our company is. So there's a couple of things that you should look for when you're investing in a royalty company. Number one, you want it to be as pure play as possible, meaning that you want it to have as much exposure to precious metals. Precious metals is the reason our company exists. It's the reason that our investors invest in Nomad. And so currently we have 77% of our portfolio from gold, just under 25% from silver. And we aim to keep that dynamic for the foreseeable future. We really believe that the more we can stay tied to precious metals, the higher valuations we will get. And this is something that we've seen from experience in the royalty space. Similarly, or equally important, I'd say, is the stage of assets within your portfolio. The difficult thing in the royalty business is building a portfolio that has cash flow. And so, we're very fortunate to have over half of our assets that are currently producing, and two assets that are coming online over the next year. And so by next year, we will have over 85% of our assets that are currently producing, which is not typical of smaller royalty companies, and we think is a major differentiating point between ourselves and some of the smaller royalty peers out there. From an overall delivery point of view, what that means for next year, we're expecting about 25,000 gold equivalent ounces, which is a meaningful level of production for a company our size. I've talked a bit about the portfolio, and I've laid it out here on the map. And I think one of the things that should stand out to you when you see this page is the fact that it is globally diverse. When you're building a portfolio of royalties, it's very important, as I said, to make sure that you don't have concentration of value in one specific area. And that is something that we're very focused on. And we're happy to say that the assets that we've been able to start this business with are located globally. We have some in North America, some in South America, West Africa, South Africa, and Australia. I'm not going to go through them one by one, but I will point out perhaps a couple different assets that I think are worth noting. So number one, we just closed the acquisition of Coral Gold last week. Coral brings us a royalty on the Robertson property. I'll move on to the next slide. Robertson is a significant royalty for Nomad, and the reason for that is it's an important land. It's an important piece of land owned by Nevada Gold Mines that forms part of the Cortez complex. It's just a few kilometers away from the existing mills in the camp. Currently has a at surface oxide inferred resource of just under 3 million ounces. But we know that it's a property that has significant exploration potential and at depth. And this is a camp where the discoveries at depth have yielded some of the world's largest gold deposits. In their last investor presentation, Barrick did mention that they intend to bring this property into production before 2025, so within the next 4 years. We know that they are currently doing the work to currently put the oxides into production, but also to continue and explore the property, which is something that hasn't happened on this particular piece of ground for a few years now. But the potential for discoveries at depth is significant. But importantly, for Nomad to have a royalty on one of the best mining operations in the world, where the operator has told the market that they intend to put into production within the next few years, really puts us apart in terms of the types of assets that we have in our portfolio. Again, there's only a few royalty companies out there that have royalties on Cortez. All of them have market caps that are measured in the tens of billions of dollars. So we're very happy about this acquisition, and we look forward to continuing to inform our shareholders of the developments of Robertson over the next few years. The royalty itself is it's a sliding scale, which also makes it unique. So as the gold price goes up, the royalty rate goes up. Currently, we're looking at a royalty rate of 1.75%. But that can go to 2.25% with gold over $2,000. So it's an interesting time to own a royalty like this one in a rising commodity price environment. And the other interesting feature about this royalty is that there is a advanced royalty payment that becomes due should Barrick or should Nevada Gold Mines not put the property into production before January 2025. So a downside protection in a sense. It's very rare to find those kinds of features in royalties, So just some added benefits that we like about this royalty. From a valuation point of view, I think this is perhaps one of the most important topics today. I mentioned earlier, we're a new company. We started trading only in May of this year. In that period of time, we listed the company at 1x NAV. This was a concerted effort between ourselves and our two larger shareholders, Orion and Yamana, to create a new vehicle of size and essentially take the next couple of years to build out the business, build out the platform, and achieve the higher valuation multiples that we typically see in the royalty space. The way we think about valuation in the royalty space is essentially there's two separate groups. We have the junior and intermediate companies, which is the first box that you see on that top chart, that typically trade in that 1.5 to 1.7 times net asset value range. Our intention listing Nomad is in the first step, reaching that level of valuation, and our company traded within reach of that just over the summer. With a recent pullback, we've come back down to 1x NAV. So in my introduction, I mentioned that there's a significant opportunity right now to enter into an investment of Nomad, because it's the same listing valuation, but the business is significantly more advanced than it was when we listed the company. We've already put out 2 quarters, we've made 3 acquisitions, we are established now. And so the opportunity to invest at these valuations, we feel, should be very attractive to our investors. And in the long run, our goal is to achieve that higher level of valuation that we see from the Franco, Wheaton, Royal Gold. That is a longer term goal, but our intention in creating Nomad is to create that next $3 to $5 billion vehicle that can achieve those multiples. We've had a very busy year so far. So not only did we create the business, but we've been very active in terms of establishing our roadmap and checking off the boxes in terms of setting up the business. So we completed the RTO in May. Since then, we've announced our TSX and OTCQX listing. We've set up our credit facility for $75 million, which is a very important part of our strategy in terms of how we're going to finance new acquisitions. So that was a major catalyst for us. We've also added 7 research analysts, or I should say 7 analysts have initiated coverage on Nomad, which is a substantial amount of research coverage for a company that's only 6 months old. So we're very happy to have been able to bring that. And we've paid our first dividend. As I mentioned, we're yielding about 1.8% today. We also executed our first 3 transactions. One, the first being a royalty on the Troilus project in Quebec. We acquired a royalty on a producing mine in Arizona called Moss, which is operated by Northern Vertex, and as well bringing in the Robertson royalty into the portfolio. In terms of our upcoming catalysts, essentially we're continuing to build out the market visibility for Nomad with 7 analysts covering us. We are well positioned to continue and add new institutional investors into the story. But also I should mention that we have 2 assets that are coming online within the next year, which will just further add to our cash flow and overall scale for our business. I've talked a bit about growth. Growth is an important part of royalty companies because that is primarily how management teams build the per share value within these businesses. So for us, all avenues are good when it comes to growth. We're looking at as much as financing situations as acquiring existing assets, but also mergers and acquisitions. The royalty space is I'd say there are many companies out there today, and so certainly we are making sure to stay aware of everyone out there, and M&A is certainly on the board when it comes to growth. Really, what it comes down to in a royalty business, it's a very simple strategy: is stay as pure play as possible, stay steady in terms of how you present your strategy to your shareholders, continue to deliver on transactions and growing the portfolio and growing that diversification. And time and again, we've seen when companies stick to their strategy in the royalty space, they can deliver tremendous results. I talked a bit about the team. Here are myself and two partners in Nomad, Vincent Metcalf, Elif Levesque. The three of us work together at Osisko Gold Royalties. We're key parts of growing that business and have now formed the basis of this company. So we're not new to the royalty space, and we're backed by significant shareholders with significant firepower, who have representatives on our board as well, so that we can move in lockstep as we execute the strategy for Nomad. In terms of our capital structure, we're about a $640 million company based on today's closing price. Well capitalized, $20 million of cash on the balance sheet, $75 million available to us under our credit facility, and no debt on the books other than a final payment owed to Yamana in 2 years of $10 million. So very well positioned with a clean balance sheet. So in conclusion, why Nomad? Comes down to the team. We've built a royalty company before, and we're going to do it again. Truly, this is the ground floor opportunity. With gold doing what it has done over the past few weeks, it has opened up a new window to come in at the ground floor for Nomad. We are 100% gold and silver focused, and it's something that we're going to stay definitely focused on as we continue to grow the business. Cash flow forms the base of our business, as much so today as we grow out the business in the future. We're looking to continue to add cash flow to the portfolio. And really what it comes down to is we are a team that owns significant personal stakes in the company, and we think like owners in everything that we do. And we walk the talk as well. We're all currently buying shares at these valuations. We've been filing our steady filings over the past few weeks. So we really believe in this business, and we're always happy to bring in new investors. And so at this point, happy to open up the Q&A for anyone that has questions.
That was really very interesting, Joseph. Thank you. We'll look around for some questions. Marshall Barrel, are you with us? Would you like to ask a question?
Yes, I am, and I would, and thank you, Joseph, for the presentation. A couple of questions. One, you have a lot of shares outstanding, over 500 million. Is there any thoughts, or what are the thoughts about a consolidation?
Yes. So the reason that there are many shares outstanding currently for Nomad is because of the structure on how we brought these assets to market. We used reverse takeover, and so the share structure in a way reflects the share structure of the shell that we were using when we started the business. Typically, when we think of companies that have high share counts, we associate it negatively because the way that usually happens is because of many decades of dilution and share issuance. So that's not the case here. But we did approve when we approved the listing. We got our shareholders to approve a consolidation. So it's something that we're thinking about. We want to make sure that we do anything that we do is done in such a way that it doesn't hinder our trading liquidity. Liquidity is key for us. We're continually working to build out not only the number of investors, but the number of dollars traded on a daily basis. So it's something that we're going to continue to look at over the next year, I'd say.
Okay, and then as part of the liquidity, you've got a little over 80% held by Yamana and Orion. Have they said anything about what their plans are or intentions?
Yeah. So
in conjunction with the stock and the amount they hold?
Yeah. So Orion and Yamana acquired their shares essentially because those were the two separate groups that owned the portfolios that we acquired to start Nomad, and so they're founding shareholders of Nomad. And in each case, you know, they elected to take back shares over cash. Yamana did take some cash, but predominantly shares. And in the case of Orion, the way this was thought about really was not a sale of these assets to Nomad, but really kind of a repackaging. They believed in the concept that we could take these assets and deliver superior value over a longer period of time. And so, you know, very aligned with the strategy on a long-term basis to build value for Nomad. When we set up the business, they did agree to a 12-month lockup. And so that, you know, began in May. But, you know, truthfully, I think the way, you know, to think about their involvement in Nomad is long-term. They want to see value being created. They're very happy with, you know, the development so far. Similarly with Yamana, it was a very similar situation. You know, they had a royalty portfolio. Were trying to decide whether to monetize for cash or you know, buy into the concept of building a new vehicle that over time can generate, you know, more returns. They are obviously a smaller shareholder, and so from an overall point of view, you know, royalties are not core to the Yamana business model, as everyone can imagine, and so we would expect them to reduce their position over time with opportunities, but in a measured and managed way, and always, you know, in conjunction with ourselves and in a way that's helpful to the overall liquidity and value picture for Nomad.
Okay, thank you. I appreciate that, and as a shareholder, I appreciate the work you're doing and the progress you're making. Thank you very much.
Thank you very much.
Let's see. James Robinson have any questions today? If he could unmute himself. Mr. Robinson, you have to unmute yourself.
He may be having difficulty. I did want to just mention as well, Marshall, just make sure you're muted. There was a strange echo. I'm sure you are, but that would be helpful. And James, if you can unmute, otherwise we'll circle back to you.
I was muted and I'll remute myself.
Thank you so much.
Jeff Masseri, are you with us? Can you unmute?
Yes. Yes. Hi. Great presentation, Joseph. That was very interesting indeed. I have a couple of questions. Do you have any buybacks?
Within the portfolio, there are no buybacks, no.
No buybacks. Good. Okay, thank you. And who did you buy the Robertson royalty from? From Nevada Gold?
No, so we acquired Coral Gold. Coral was a publicly listed company that owned the royalty. It was their only asset, that and some cash, as well as some, you know, some lesser important exploration properties. But it was, for all intents and purposes, a royalty company trading at, in our view, an attractive valuation with one of the best royalties out there.
Mm-hmm. Yeah, it looks very interesting. Thank you. That's okay. Thank you very much.
Thanks, Jeff.
How about Michael Hebner? Are you with us today?
Yeah, this is outstanding. I own Coral Gold, so I want to thank you for making me a lot of money on that. And I haven't seen a deal look this attractive since Ian Ball brought me Abitibi royalties at $2, and now it's $24 on that asset that you guys were involved with. And then the second best, that Metalla, we picked up on when it was like 1 times this. And so when I'm looking at this, the only thing, I'm a broker down in Michigan. So the issue we have is like the US listing. So So if you could do a stock split and get it on one of the exchanges, we can put it in a lot more accounts a lot quicker. Because with that F, it means forget about it, right? For a lot of the clients, we have to move it in slowly. So I mean, I'm excited about this. I mean, I don't see if anybody else is on this call. I hope they're not as excited. I probably should be quiet because I don't want to pick up some shares tomorrow on my own account. But I mean, this is outstanding.
Thanks, Mike. And it's, very pleased, that you were a Coral shareholder and were able to come in through that acquisition. I think a number of other shareholders are in your situation. The shareholders of Coral did well over the years through their investment in Robertson, and we think that that's not going to end. And so we've had the opportunity to speak with a lot of Coral shareholders. A lot of them are excited to continue and hold their shares and participate as we continue to grow the business. But you're right to say it's the unique point in time for us. We didn't think that we'd be giving everyone a second chance to invest at these levels, but here we are. And so, for anyone on this call, I think it's important to consider that as you're considering Nomad from a timing point of view. There's really never been a better time.
Yeah, and I see that you, speaking of that, you bought 10,000 shares one day, 10,000 another. And then the other people are buying shares here recently. And so, I mean, you're leading from the front. How many other shares do you have in addition to those?
Myself personally, I just over 6.4 million shares now.
You have 6.4 million shares.
Correct. And same goes for my partner, the CEO of Nomad, Vincent Metcalf, and Elif Levesque has a significant share ownership as well. So we're not lying when we're saying that the way we think about getting paid in Nomad is through our share ownership. We're thinking like owners first. We have really, all of our wealth invested in this. At these levels, for us, it's the same kind of like no-brainer type mentality that we had earlier this year when we listed the company. We really think it's a good valuation and something to consider.
So that asset that you bought, the Coral Gold asset, is there any way that they'll move that quicker if gold moves along, or what's your best guess on what's going to happen there?
Well, the challenging thing about having a royalty on a Nevada gold mines property is they don't say much, but the fact that they talk about Robertson, I think, is fairly significant. They don't tend to talk about properties that are not important to them. They did talk a lot about Robertson in their last Investor Day presentation. We obviously saw the work that they've been doing over the last few years. It was clearly work that was geared towards bringing a property into production. And that's for us what kind of separates this royalty from other good exploration royalties is the fact that we're actually going to get cash flow from this thing, in a relatively near future. Other than what they're saying, we can give you more visibility on timing. But big companies can move quicker in good gold price environments. And the thing here too is to understand is that Cortez is, it's Barrick's best asset and most important asset. So they have a vested interest in making sure that it works, that it delivers on time, and that it continues to generate returns for a very long period of time. And the nice thing as well about Cortez is there's a significant amount of infrastructure there. So between oxides, sulfides, they can process really any type of ore, which makes it, makes this property ideal for them to continue and find ounces.
Great. I really appreciate your time today. Look forward to working with you. Thank you so much.
Thank you.
Michael Potter, do you have any questions?
Yes, I've got a couple. Thanks for a great talk, Joseph. My first question is totally trivial. The sticker NSR, net smelter return, was that pure chance or was that planned?
No, it was planned. we were surprised it was available, to be honest. 15 years into the royalty business, you'd think that it'd be taken. But we were fortunate to get it. I think it's a very easy symbol for investors to remember. It's highly representative of our business. So I think it just makes it more interesting.
Okay, great. Now on to something a bit more serious. How do you're predicting 25,000 gold equivalent ounces for next year. How do you see that growing over the next 5 years or so? And is there anywhere that you might expect to see a really nice uptick into what you're expecting at the moment?
Yeah. Right. So from next year's level, I'd say the key asset that's going to continue to deliver ounces for us, and that's coming online as we speak, is an asset called Blyvoor. It's in South Africa. A very meaningful asset from a mineral endowment point of view. So it's a mine that produced for 50 years. It produced over 45 million ounces of gold. It's the typical reef systems that you see in South Africa. They're literally mining the same reef as Mponeng, which is now owned by Harmony. So this asset has 26 million ounces remaining. It's being put back into production under very different mining scenarios, and more selectivity, and overall just more profitability. And because it's owned by a private company, they're taking a conservative approach to bringing it back online. So we have a 10% gold stream on the asset. We're forecasting it eventually to produce 130 to 160,000 ounces a year. But that is I would describe a very achievable target for them. They have the opportunity to expand. They have many different opportunities to get the level of production higher than that. And because we have a big stream on it, 10%, there's a big difference between getting a mine that produces 100,000 ounces a year to 200,000 ounces a year. So what that means for us, next year we're forecasting 25,000 gold equivalent ounces. That's assuming kind of a year of ramp up for Blyvoor. The following year could be significantly better with Blyvoor at full production. And then who knows if they expand, if they just get more productivity that they were expecting, the numbers could get bigger quickly. That's one example in the portfolio. Obviously, Robertson, we don't have anything currently in our forecast for next year, because it's still an exploration property. But Barrick don't tend to put assets into production that are small. So this could be a very good boost to our production as well. And those are two examples. There's many others in the portfolio.
Okay. How deep is Blyvoor?
So there's two reefs. There's one that's about just over a kilometer deep, and then the second reef is a little bit deeper than that. I want to say 1.8 kilometers. Okay,
so not particularly deep in South African terms.
Exactly, and the entire reef is dipping. Harmony, they're mining substantially deeper than Blyvoor, which is beneficial in a number of ways. Number one being that the water is mainly pumped by the other operators in the region, so that there's a very low amount of pumping being done on the Blyvoor property. But you're right to say it's not very deep from a regional point of view. I think the other thing to keep into consideration here is that this is a mine that's been mined for 45 years. So everything is still in place, in amazing shape. It's probably one of the nicest underground mines I've visited in my life. Substantial amount of development that exists already into the ore bodies. So from a execution point of view, to bring this mine back into production, it's not a greenfield by any means, and we feel very good about the types of production that we may see from this asset.
Okay, great. And one last quick question. I saw on your map you've got nothing in Europe and Europe and Asia yet. Is that just by chance or by choice?
Yeah, I mean, we think about jurisdictions really from a mining culture point of view. So if the country has existing mines, if they have a history of mining investment, labor force, those are areas that we like to invest in. And we think about each jurisdiction as on a one-off basis that we can bring into the portfolio in a measured way without taking too much, too big of a bet on any specific jurisdiction. There are certain places of Europe we'd be happy to invest in. Asia's probably off the list for now. Between North America, certain countries in South America, West Africa, South Africa, Australia, and as I mentioned, certain countries in Europe, there's many opportunities there, and a lot of areas within what I mentioned where the royalty and streaming space hasn't really been so predominant and where the opportunities are plentiful. So we don't feel the need to go to any ultra high risk areas, to build out the portfolio, at least not in the near or medium term.
Okay, great. Great, thanks for the explanation. I wish you the greatest success.
Thanks
Cheers.
very much.
Dr. Wood is here, actually, sorry.
Oh, yeah. Couple of questions. With respect to the Coral Gold property, who did you pay the money to for the royalty? Was it Coral or was it Barrick?
Coral. Yeah, so Coral previously owned the Robertson property. They were an exploration company. They did some drilling on the property. It was right next to the pipeline mill. Eventually, Barrick took notice. They acquired not the company, but the property in exchange for a royalty and some cash. And so Coral became a royalty company. So they continued to hold this royalty and that cash for many years. They never spent the money other than to buy back their own shares. And we came in earlier this year and made an offer to the shareholders of Coral to acquire their shares. So essentially, we bought the company, and it's now privately owned by Nomad and still holds the royalty.
And how much did you pay for that royalty?
It's about so the overall acquisition price was about $46 million, which
Okay.
included about $10 million of cash.
Oh, but now didn't Coral sell that property for $20 million in total?
That was, yeah, in about 5 years ago.
To Barrick?
Yeah.
Oh, okay. And then, so okay, thank you for answering that.
You're welcome.
Do you have a ballpark figure of how your consolidation, how great it will be? In other words, if you have 500 million shares out now, what would be your goal? How many shares would you be shooting for in a consolidation?
Listen, we don't have any, or I should say, we don't have a specific intention at this point. I think the key concern for us would be to make sure that we're not consolidating in such a way that we're hurting our own liquidity. Because between, I think it was brought up on a question earlier, between Orion and Yamana, they own substantial component of the business. So one of our key objectives right now is to build the liquidity of Nomad and bring in new shareholders and increase the trading liquidity and overall dollars being traded on a daily basis. Those are things that we would take into account when we choose whether or not, or the timing and magnitude of a rollback. And again, there's no specific point in time that we've pinpointed for this. It can be next year. It could be later in the year. Things could happen between now and then. We may acquire more companies. So all of those things would have to be taken into account. So unfortunately, I can't give you a specific number right now, but hopefully that gives you some color in terms of how we think about that decision.
Well, you probably would go somewhat by share price needed to be on whatever exchange that you wanted to be on.
And there's a number of different requirements.
Right.
Yeah.
What going to your Guanacomayo project that you have a royalty on?
Yeah.
That was originally a Viceroy property, and I think Yamana bought it. But is it being the output increased, or is it dwindling? I had thought that they were not doing as well on that particular property as they wanted.
So so the asset was a Yamana asset. They sold it to Mineros, who now owns it. And there's two components to Guacamayo. There's the oxide mine, if you want to call it that is currently producing. It's the type of operation that they continue to find new oxide zones and to bring them into the mine plan. And the real reason that Mineros bought Guacamayo is for the DCP project. So there's a DCP, or what they call the deep carbonates project, which at the time of acquisition was about 2.5 million ounces. They've publicly stated many times they believe the potential is for over 5 million ounces.
Oh wow.
So they're exploring. They're essentially using the cash flow from the oxides to continue to expand that underground zone. It's a project that would require a fairly substantial investment on Mineros' part to bring it into production, given they would need to build a new mill. But it is the reason that they bought it. And so you're right to say that I would say it's a mine in transition. They're continuing to mine the oxides that they know of. They're still finding oxides, and but more importantly, evaluating how to bring on DCP.
Now is it an underground mine currently or an open pit?
Underground, yeah.
Okay.
And
excellent presentation. Let me ask you this: if I send my email in to David Mandy, would you send me a copy of your presentation today?
Absolutely, yeah.
Excellent. It was excellent. I love the comparison slides with the various companies, various royalty companies. I think that's an eye opener, and I do appreciate that. Thank you
very much.
So next, let's see, Michael Potter. Oh, excuse me, Stratos Manolis, are you still with us?
Can you hear me?
Yes.
Hello? Yes,
yes.
Thanks. I have a couple of questions. Can you tell us the average life of your cash producing royalties? The mine life, I mean, the average mine life.
So right now we're saying 12 to 14 years is depending on how you view certain projects. The outlier in that is Blyvor that I talked about on the last question. Given the mineral endowment there, it's a mine that could have a 40-year life. If they choose to kind of develop the mine to that scale. So 12 to 14 with some outliers is how I'd answer your question.
Okay, and can you please, in case I missed it because I lost sound for a while, can you give us an idea of the expected cash flow, the free cash flow for 21 and 22, and just an idea?
Yeah. So listen, there's many variables that go into it. I'd say if you take a $1,700 gold price, and maybe just to take a step back, our cash flow is easy to calculate because you're basically taking the ounces times your gold price times your margin. We have about 80% margin, or 77% more specifically. But at 1,700 for 2021, you're looking at between 30 and 40 million dollars US.
Right, and you're trading around 600 million market cap at the moment.
640 in Canadian dollars. 640
So
Canadian dollars.
640 Canadian
So
dollars.
that's 575 US.
Right. Also, you do have a credit facility of 75 million.
Correct. Yeah.
Is this provided by the private equity or someone else?
It's
or the private
a syndicate of Canadian banks. It's led by
Uh-huh.
Scotia, but also CIBC and RBC.
Are
So-
there any guarantees from your major shareholders?
No, not guarantees from the shareholders, but it is a secured facility, as you would expect from a major Canadian bank. The credit facility, the way to think about it is, royalty companies have done this over and over again. Really, it's an acquisition tool. So we use it to be able to show, our parties that we're doing deals with that we don't need financing, which is a major point when you're negotiating a deal. If you say, here's the price I want to pay, but I need to go and raise money, then you're not getting a phone call back. So the credit facility is important to get you to the table to get the deal done. But we don't think about it as a long-term part of our capital structure. So when we draw the capital, number one, it means that we're buying cash flowing assets. So we're increasing our cash flow base. It gives us better visibility on how to repay it, either using our cash flow or refinancing if we think that there's a good cost of capital arbitrage between our issuing new shares over the credit facility. And over time, this is what we've seen royalty companies do: is pull the facility to do a major transaction, refinance that transaction with equity, and then you're ready to go again.
Right. So okay, I assume the way going forward is if you buy a cash producing asset, then you can pay mainly from cash. But if it's exploring asset, you prefer to issue shares, to give shares, in order not to dilute the shareholders. I mean.
Yeah, exploration assets, we would typically think of using cash from our royalty streams.
Right. Okay. Thank you very much for the presentation. Thank you.
Thank you.
Okay, I think that's the panelists. Scott, do we have any questions from the audience?
Yeah, we have one question actually, and it is, can you discuss your plans for the dividend over the next 5 years or so? Do you expect a consistent growing of the dividend?
Yes, so the answer is the dividend is very important to us, primarily because, I mentioned on the call, we're trying to build this platform into something bigger. We see the real objective being somewhere in the $3 to $5 billion range from a market cap point of view. That's where you get that significant scale where you can attract a generalist audience, and the type of investors that have historically made royalty companies work very well has been that generalist audience. And so we want to lay the groundwork today on the dividend side and in everything that we do to show, ultimately in 3 to 5 year time, when we have, major pension fund investors coming in, that we're dedicated to the strategy, that we're dedicated to building a strong dividend, and that dividend having it be, more substantial than the peers. So coming out of the gate with a strong dividend was important to us. We're about a 30% payout ratio right now. That can increase over time as we bring in new cash flowing assets, as some of our portfolio assets come online. And so, the point is, the way we're thinking about it, the payout ratio can increase, and overall, we expect the dividend to increase.
Thank you. That's it from the field.
So that's all of our questions today?
That is.
That's a very thorough panel working over of Joseph here. Joseph, do you have any closing remarks you'd like to make? You want to be sure we remember?
Yeah. So I've mentioned it a few times. I really do think that it's a good time to be looking at Nomad. If you haven't if you haven't met with us previously, please send us an email, get in touch with us. We are very open to having a video call or phone call with anyone that wants to talk to us. To book a meeting, it's quite simple. Go on our website. There's a button right at the top of the page that says book a meeting with management. That gets you right into myself or Vince's inbox, and you'll get an email back within a day. So don't hesitate to get in touch. There's lots of other things that we haven't had the opportunity to talk about today on the panel. But there's many different good things going on within the business, within the portfolio. So please have a look at Nomad and reach out if there's any questions. Other than that, thank you very much for listening in.
That was great. Thank you very much. And thank you everyone for attending.
Thanks everyone.